Well, for the time being, let's talk about the RBI project finance rules now. Banking sources tell CNBC-TV18 that banks see the 5% general provision for project finance as too high. Ritu Singh joins us to fill us in with more details on that. Ritu?
Well, a lot has been said and made of the proposed project financing rules which RBI issued for feedback earlier this month, some worrying about the hit on balance sheets, others terming it a deal breaker for project financing because of the steeply higher provisions. So we've been speaking to a whole host of large banks, including public sector banks that have a more substantial exposure to these infrastructure projects, to understand the kind of feedback that they're going to provide to the RBI before that 15th of June deadline. And clearly, there is widespread discomfort among large banks on that 5% general provision which is proposed at the construction phase of the project itself. The large banks we spoke to believe even if provisions are to be raised from the current 0.4% levels, perhaps a smaller hike of 1 or 2% could be considered. Other banks believe that maybe instead raising risk weights for project financing during the construction stage could serve the better purpose if the concern is to price the risk better. The second major change which banks are likely to propose is that RBI allow for a minimum 1 year of moratorium period after the DCCO or the commencement date of a project in the case of non-infrastructure projects, and 2 years moratorium for infrastructure projects instead of the 6-month cap which has been proposed. Besides these, banks are also going to seek clarity on whether RBI is going to propose a floor for the exposure above which these rules would apply, say a minimum of 1,500 crores or so. Now, besides this, we understand NBFCs are also in the process of firming and submitting their views to the RBI separately.
Okay, thanks a lot for that.